Hey guys, welcome to this week's podcast episode. And I've got a fantastic guest for you today, Tim Clifford. And he has a lot of experience and background in the financial industry, trading, investing, advising. He's got a lot of experience. And for the doctor audience out there, this is particularly interesting, just given, the what's going on in the world today and the need for financial literacy. So I'm happy to welcome Tim to the show. Welcome, Tim.
Thank you. Thank you very much, Doctor. Great to be on.
Yeah, and this podcast is very informal, and I hate titles, so just everybody calls me Chris. So
Okay,
talk
good.
about it's interesting. You have a storied career. You were a trader. You worked on the Chicago Merc. Talk about how that all played out. You also joined Charles Schwab, and what you do now.
So just a quick background. I started after college, went into the commodity business, traded and worked on the floor. I made a lot of money and lost a lot of money. So kind of in the end, I was like, this isn't really the right place for me to be. I was about 30 years old at the time, and I had an opportunity to go to work at Charles Schwab. At that time, they'd opened up a call center, and I went to Schwab and worked in their branch in Indianapolis for about a decade, kind of combined. So a combination of some stuff. And one of the things that I really learned between the trading and Charles Schwab was people that were trying to pick the market or trade short-term investing were very different than the people I was serving at Schwab, who were much more, had longer timelines in their minds and thought a little bit longer term, and then literally had a lot of money. So that was kind of my aha, and that's kind of what's taken me to kind of where I am today. And I'm in Central Florida quickly. So I'm in Central Florida as a financial advisor, and I have my own practice.
Yeah. Really great intro. And so, first thing is, this, especially given today, we've got Robinhood, and then, there's like GameStop and all this GM, whatever, AMC, all this stuff. And, everything is basically the millennials and Gen Z, they see their future being wasted by the government and debt. And so this is like kind of their only way to get out of it is through this meme and trading. And so talk about how, there's this generational difference between, long-term wealth and just people trying to get rich quick. It's almost like a lottery. People are trying to win the lottery. Talk about that.
So two core philosophies. So the first one is financial success is not some event like what you're talking about. It's I had a bunch of the right stock, I hit a lottery. It's definitely the combination of decisions that someone's made over the course of many decades, right? So it's a longer term strategy, and one of the things we have to do is think longer term. The second, and equally or maybe even more important philosophy, and I get this from Charlie Munger, is people kind of already almost have to be there, right? And what I mean by that is if someone's going to help someone build wealth, and you're trying to tell them that you need to think in terms of longer term, wealth is built long term. It's not built overnight. And someone's thinking short term, it's very difficult to move them to a long term view. So they kind of almost have to be there in order to really help them get there. And that those are kind of the core two philosophies that people really have to ingrain in their heads. And I can't do that for them. That's something that someone has to kind of start with.
Build long-term wealth in today's climate, because we have people coming out of college, 500, I've even heard, ridiculous amount like $800,000 in debt, can't find a job. And, basically the government's like forgiving these student loans. It's like kind of, all this bogus. And then like, how do you financially get ahead? Real estate is just appreciating so fast, interest rates, markets are very volatile. So how does one get ahead? So how does one get ahead?
So there's, I mean, there's a lot of different ways to look at this. One of the things that I think is really important is to understand that, how does one get ahead? So, there's, I mean, there's a lot of different ways to look at this. One of the things that I think is really important is to understand that, how does one get ahead? So there's Three pieces that I really start with. The first two are tactical. So you got to have a plan. And I don't mean some 45-page document you get some from financial advisor you put in a goddamn desk, right? But it might just be a one pager. I'm here, I want to go there. So basically here's their strategy. And you've got to have that written down, of which your significant other has to play a part in. Okay, I can't tell you how many clients I sit down with and they're trying to build wealth, but their significant other is not on the same page. So first, you got to have a plan. Second, you got to be diversified. And that doesn't mean you have to be massively diversified, which I can tell a little bit quickly story around that, that I learned years ago. And then the third, and it's much more difficult, is seek advice. So the first two are more tactical, but strategically difficult, right? So if you sit down with 20 financial advisors, the plan's going to be basically the same. What's going to change is the order in which someone does it. So if I sat down with you, Chris, and I said, okay, well, let's go put all this stuff together. And then in the end, we're going to say, let's go do max out your 401k as an example. Another financial advisor might say, pay off your debt, right? So the order matters, but the plan won't be that much different. The same true with the diversification. The third one, seeking advice, that's the one people have the hardest time with. And to be honest with you, doctors, CEOs, C-suite executives, I mean, these are smart people that make a lot of money. That's the hardest one of all, and maybe harder now than ever because they can get the information from someplace. So building and learning how to seek advice is very difficult.
Brings me to this cohort of doctors. A lot of the audience are physicians. And so, kind of, my view, because everybody was like, once you got into med school is like your future is set, but that's actually not true. You got so talk about this concept. Really important is making money does not equate to having money. It does not equate to wealth. So talk about this idea where, because people are thinking doctors make a lot of money, but a lot of doctors are broke as well, similar to professional athletes or celebrities. Talk about that.
So that take me back to how I started this with my trading. So again, I worked with a lot of really wealthy, rich people when I was at the Commodity Mercantile Exchange. And then when I went to Schwab, I started working with a lot of also wealthy and rich people. And my aha, I'm not sure when it happened, but maybe it was over the course of time. In Indianapolis, on the north side of Indianapolis, like most cities, they have like the area that's like the richest people. But there's a lot of other cities that have all the makings of wealth. Okay. And it was interesting because if you were in Indianapolis, it would look like there was similar money in a suburb called Fishers. And when you looked at like greatest place to live, you looked at income from the IRS, you looked at you drove down the streets, you looked at the cars, all of it looked the same. It looked exactly the same. Interesting enough, you could not tell the difference. But when I worked at Schwab, we had the ability to sort and look at, okay, where's most of the money that we're helping people with? And Chris, it was shocking is not the word. It was almost amazing how much of the wealth in our branch, and back then, now this goes back, 20 years. So it was a big branch with billions of dollars. It was incredible how much of the wealth in that account was in two zip codes in Indianapolis, 46033 and 46032. And again, you couldn't, if you didn't see that, because I worked at Schwab and I had the ability to sort it, you wouldn't have necessarily believed that based on reports or news or anything. Number of cars sold, number of people driving Mercedes Benzes, all that would have looked kind of similar in 4 or 5 communities. But as a person at Schwab looking at, okay, who has $1 million account? Who has a $5 million account? 46032, 46033, almost uniformly. I mean, it wasn't even it was crazy, actually. I was shocked by it. And that's actually why I wrote this even book and that's really how I've built my business, is based on that exact concept. I'm like, wait a second, this trading is high anxiety, very uncertain. How are these people with money making money and building wealth? And then I came across kind of this, and again, it wasn't kind of overnight, but people that have a lot of money have a plan. They're almost all diversified, and probably, and again, I said this earlier, but that third one of seeking counsel is just insanely difficult for smart, successful people.
Yeah, it's really, like I said, it's like kind of it's like you think there was this really interesting post that I read. It was like, you could be broke and you can be driving a Mercedes and eating out at fancy restaurants and people think you're rich, but then it's like I know some doctors, they're very good with money and you can never tell. It's like they drive a Camry, it just 10-year-old car, but they save 90% of their income. They can afford to do a lot of things. So it's in actually money is a currency, which is really interesting. Money is a currency that governments can print. So it's actually just paper and ink. And it's actually, you have to convert it into assets like real estate or stocks or businesses. You have to actually do something with
Absolutely.
that. Yeah. So, kind of talking about, one of those books, we'll talk about your book specifically, but talk about one of these books really is the Psychology of Money and also the Millionaire Next Door, talking about what should you be doing, like high income earners, and a lot of doctors, they basically spend every cent of their paycheck on these liabilities and they don't save anything. So what should doctors be doing to convert their money into wealth?
It sounds ridiculous and simple, but they got to live within their means. They just don't. There's so many of them that, but and it becomes a mindset, right? Because it becomes this. I worked 100 hours a week for a decade, and I now have this big job. I deserve X. So it's a really difficult process for the family. Again, and the family and the person doing it to say, okay, well then we can't live in this house. We can't drive this car. Living within your means is just incredibly important. And I know it sounds overly simplified, but that's probably it.
Yeah, yeah, because as a physician, it's really tempting because you see your colleagues, just lavishly spending, and it's just like, a lot of it's wasteful, and you're kind of tempted. You're like, oh yeah, I could do that too, and then when you do it, it's actually feels good. It's like, oh, then you're tempted to do more. So it's kind of like, of course, you have to enjoy the fruits of your labor because you can't. When you die, you can't take your wealth with you, so you should enjoy some of it, but you should also always pay yourself first and always save. So next question I have for you is, based on the audience, is this mindset and financial guidance and decision making, um, as well as investment strategies and diversification. So, why is diversification, asset allocation so crucial in wealth management? And share some practical tips.
So concentration creates wealth. Diversification preserves wealth. Okay, so that's a kind of a core that goes back hundreds and hundreds of years, right? So if you want to get rich on your investments, not on your income, but on your investments, you're going to have to be concentrated. So diversification, though, is one of those things that preserves wealth. So as an example, I had a really good friend. He was 25 years older than me, but we were really good friends. He had a bunch of money and made a lot of money, and he used to tell me, he'd say, Tim, just put all your money in the S&P 500 and you'll be fine. And I told him, I said, Joe, that's not how you got rich. I said, because he put all of his money in those Napa Auto Parts franchises. And then once he got rich, he sold the Napa Auto Parts stores and did diversification. But there's an art to the diversification and to the concentration. And that art is pretty what do I want to say? It's pretty tested. It's pretty tested with companies like Goldman Sachs. So they'll use a couple words when they talk about this. And if you sit down with a Goldman Sachs advisor, they'll have what they call either a core satellite strategy or core explore strategy. It'll be something like that. And basically what happens, just like the core of an apple, the core will start off small, and then you'll have these satellite investments. So you'll have your real estate, you'll have your gold, you might have, maybe whatever, Bitcoin. You could have all kinds of investments on the outside, right? But
Yeah.
at the core becomes this diversified strategy that you kind of follow. When you're younger, that core is relatively small, and then your satellites are much bigger, because that's where you're going to hit the home runs, right? But you're still diversified. You'll have 5 or 6 stocks, 10 stocks, 20 stocks, 20 investments. So when I say stocks, I don't mean it could be 20, 30 investments. But one of those investments, if you're really disciplined and kind of think through it, one of those investments will go up tenfold. You'll have an Amazon in that. You'll have a Microsoft. You'll have something like that. And then as time goes, your core becomes bigger, bigger, bigger as your wealth grows and you get older. So when you become, 60, your core probably is 50 or 60% of your portfolio, which is a real diversified, disciplined model, right? But your Explorer still, or your satellite still exists. So that's the strategy that I really try to help people kind of. It's simple, and it's easy to execute on, and it's easy to kind of do. So that's kind of my best advice for people that want to get rich, because you will get rich. What I just said, I've seen it happen over and over again. I mean, over time. I mean, more than likely, you'll find yourself with a stock or an investment that goes way up.
Which really, I love this idea that concentration creates, and then, because, every time, from a profit standpoint, you take off your profits and you put into the most boring thing ever just to preserve your wealth. It could be real estate or gold. It could be just kind of a boring S&P stock.
Right.
Yeah, I know a lot of people, they took all their profits and, put into something very speculative and lost everything. And, plus they have to pay the cap gains on that. So, which kind of brings me, because you mentioned Bitcoin, and it's really entered the mainstream with government, debt and printing and just instability. And it's like kind of like an alternative, a faster version of gold. So, talk about, in a lot of it with ETFs now, institutions are kind of looking into it. Talk about, how Bitcoin can potentially, kind of spice up your gains, how the asset allocation, all of that.
So I don't currently have Bitcoin in the core portfolio. And I pretty much manage people's core. That's why I explain. I'll help them with their satellite investments, but for the most part, I focus on their core investments. So when I'm working with someone younger, it may be a small amount of money because it's their core. Bitcoin is satellite. Okay. And how much you put in there will vary from person to person and comfort to comfort. But, but I really see Bitcoin. It is an investment. It's just what's the predictability of it, and
Yeah.
possibility of it. I don't know.
Yeah. Yeah. And yeah, it's kind of, and I know a lot of advisors, they've 10 years ago, they were advising against it. Now they're kind of, some of them are advising for it. And I think, moving down, it will be kind of one of those things where you have to consider it, it could be like gold or silver. It's kind of like one of those macro assets. Kind of we're coming to the end of our discussion. And so talk about the book that you wrote, why you wrote it, what it's about, how can people find it? And, we'll put all these links in the show notes at the end.
Okay. And then just to touch on Bitcoin though, before I kind of go off, there are some big advisors that are starting to make it part of a core asset. I personally haven't done that yet, but I do see, I can see that going down that direction. Exactly what you just said. Like I have 3 or 4% in gold and some in silver. Well, at some point it might be 2 or 3% in Bitcoin and 2 or 3% in gold. But it'd still be
Yeah.
core. To make any real money on it, it's going to have to be a satellite, though. It'll have to be concentrated, right? I mean, you won't be able to do it with 2 or 3% of your assets.
Yeah. 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 It's one of those, again, it's one of those assets you should look into. Again, it's not financial advice and still very early, and could go to zero as well. So talk about how people can find you. I know you had something
Yeah.
to say.
So I wrote, so very quickly, I wrote this book called Plan Assist, but it's based on everything we just talked about. I mean, it's pretty, so, I mean, it's really 30,000 foot kind of guidepost of have a plan, be diversified, and seek counsel. And the seek counsel, though, in the last kind of minute, let me just spend a couple minutes on that, because I think that's the hardest one of all. So let me just touch on that here just a bit. So counsel, that does not mean someone selling you something. So when I'm using seek counsel, I'm not using it in the sense of, oh, I'm going to call Joe and he's going to tell me I got to buy this or sell this. No, what I'm talking about when I say seek counsel, I mean no different than what you do right now with your clients. It's coaching, and they'll do it or won't do it, but they're seeking counsel, and that counsel comes in two forms. It comes in formal and informal advice, and almost everyone knows this intuitively, but they don't. That no one's ever kind of slowed down and thought about it. So the formal advice is advice from someone who you're probably paying, and it's probably very structured, and to be honest with you, has a tint of boringness to it. Because it'll have that, well, what if that goes to zero? What happens here? Even the coaching you do, I'll bet I'll have a tint of boringness, because it's stuff they just need to do and just get comfortable and go to it. But then the informal advice is the advice you'll get from your neighbor, from your brother-in-law, from your friend, even from you and I, you as a coach and me as a financial advisor. If they're not our clients, I give them advice to my like my friends is different than the advice I give to my clients, right? But it has, it's much more exciting, because we'll talk about, well, let's buy Tesla because I think Tesla can go from $200 to $800 a share. I'll talk about, well, I don't do that with a core portfolio, right? You can't do that as a core advisor. So the takeaway that I'd have is, you can find planassist.com. It's super easy. You can even download the book for free. You can buy it on Amazon, but it's on the website. You can download a PDF of it. And the takeaway that I'd kind of finish on is I would just spend some time really thinking about, do you have a circle of advisors around you that aren't salespeople, but are people you can call when you have a question about whatever it is, taxes, organization, investments, and then really learn to leverage that. Because of all the things that I learned when I was at Schwab, those people that have a lot of wealth, they have a lot of advisors around them, and they know how to leverage them and use them. And those advisors aren't selling them. They're still taking that input and doing whatever they want with it. But they have a lot of people that they can turn to and get input, where people that just make a lot of money, they don't have a lot of people around them. It's interesting because they don't like people around them, because they don't want people. They think the people are telling them what to do. So they don't even. Not only don't they have them around them, they don't even like it, right? They're just, I'll go on, I'll do my own taxes, I'll do my own research. And so of the takeaway, that's the hardest one. And I think that's probably the biggest difference between people that make a lot of money and people that have a lot of money.
Especially for the doctor cohort, some of the most smartest, educated, and they're not very willing. A lot of the younger ones are more open, but kind of the older generation, they're very stubborn and hard-headed. So, but the really intelligent ones do what you do: to seek advice, talk to a lot of people, and then make your own decisions. And I love this idea of client versus non-client, and kind of what type of advice or information that you give. So really interesting. And for all the audience, be sure to go to Tim's website, or go to Amazon, check out the book. It can be fascinating, and leave a 5-star review and follow him on his socials. And with that, thanks so much for coming on.
Thanks, Chris. Nice meeting you. I enjoyed it. Thanks a bunch. Thanks for having me. I appreciate it.